Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, February 11th, 2021. Haven't done a video update in a while. Thought it would be nice for a change. What we're seeing today is part of the general risk-on sentiment that we've seen. Yesterday we saw some mild pulling back, but not enough to really make a difference. And depending on your index, the Dow closed higher, but I ignore the Dow. The others, the S&P was a shade lower. Nothing major. It was looking pretty dicey in the morning after a rally. We saw some speculative selling, things like Bitcoin, Tesla, the risk-on type of names, seeing some selling in them. That abated. Chairman Powell spoke at 2 o'clock. That was reasonably market friendly because he went to great lengths to avoid a taper tantrum, as I see it. Which then, of course, raises the new questions about, could we overheat? Do we get inflation? I guess the market's choosing to wait it for another day to see that. And the economic numbers this morning certainly don't point to a lot of labor market inflation, since more people filed for new jobless claims this week than last, and last week's number was revised higher. So you're seeing something about how the number's coming down, but if we're not, these are still huge numbers and certainly not beating expectation, and with lower revisions, those are not healthy. We're in that sort of topsy-turvy world now where, well, we don't want it too good because that would get inflation. People are starting to worry about inflation. It's all circular. Bottom line is people still feel basically good about markets, good enough about the economy, and certainly good enough about markets to keep it moving. One of the things that I looked for there was futures, had been creeping higher more or less throughout the morning. We're up about 13 or so before the jobless numbers, and we're up about 13 after the jobless numbers. So essentially, that means they were ignored because it wasn't enough to move the needle, though it certainly doesn't tell a good story. What we're starting to see, though, is a bit of I'm not going to say a blow-off phase because that may be a bit strong, but there's definitely genuine enthusiasm in the market. And I think the feeling is that the Fed has your back. And so if the Fed has your back, you're pretty much safe to do more or less anything financially that you want. And that in the short term can be great, but it does lead to pockets of speculative excess. We saw it obviously over the past couple of weeks with the GameStop and other Reddit names. This week we saw it sort of in a quicker round trip. We saw, and not quite as extreme, we saw it in pot stocks. You're going to get these. And, the combination of new investors who like to play story stocks, institutional investors who figured out that there's money to be made playing the story stocks, hopefully being a bit more nimble in their case, they think, than the retail. These add up to little mini manias, and you do get them from time to time. I think you're not seeing them quite as driven out of the option market now, because I think the option market is getting a bit, I'm going to say, hipper to what's going on. We've alluded to this in other articles, and I do think it's crucial that you go back and read some of the stuff that I've written over the past few days, particularly yesterday, about VIX and why I think that you're going to start to see skews change. If you haven't, you've started to see it in speculative stocks. You really haven't seen it in the market overall, but you have started to see it, but it's not as meaningful in the overall market because it's harder to move a market. But you're starting to see call volatilities, out of the money call volatilities, creep up to levels above the at market volatilities, similar to, not quite as extreme, but similar to where we see out of the money put volatilities versus at monies. I'm going to talk about it in percentage of nominal, 100% being at money, 80 or 90% being below, 80 over 90% of the stock price, meaning below market, so basically focused on puts, 110, 120 basically being focused on calls. And typically you always saw what they called the crooked smile, the Elvis smile, where one side would be pointing up more than the others. I hope that works. Yeah, that sort of works there. But you're out of the money puts here having a slightly higher skew than your out of the money calls there, and your at money's being in the middle. Crude visual, but that's the way to think about it. But now I would say it's becoming more of a symmetrical smile, or in some cases a Mona Lisa smile, where it's flat as a pancake across the board, because you may have some extreme volatility in certain places. So what this means is actually a good thing if you're a writer, because if you are starting to see, if you're able to realize higher implied volatilities in many cases than you were before by writing calls, that's a good thing for you. The reason for that is because we're just seeing more demand for calls. The reason the skews went skewed, was a direct result largely of the 1987 crash. At that point they had sold portfolio insurance as sort of this weird negative gamma type of trade, which is, as the market goes down, you can hedge with futures because they're liquid, and you can sell futures to keep yourself hedged as you need, which was fine until one day everybody tried to do it, and there were no bids in the futures, and nobody had protection. So, and those who were short puts, got clobbered. So the markets started to demand more protection via puts. Put sellers raised the levels at which they would need to be incentivized to sell those puts, and so you sort of saw this permanent skew down. The same has happened recently in terms of calls. Call sellers have been burnt. Now there have always been natural call sellers, which is why the skew has never been as favorable to the sellers, to the call writers, because there have always been so many covered call writers. I think this has chased a lot of the speculative sellers out of the market. I think call writers in many cases have found themselves with stock called away unexpectedly. And I think as the market starts to figure this out, you'll start to see sort of this permanently more symmetrical type of skew. It will provide a lift to the VIX, because before the VIX was sort of took crude calculation here, take the spot at money implied volatility 30 days out, add a bit for the downside, subtract a bit for the upside, and you come up with a number that's generally a little bit above the at money. Now you're basically taking the at money options, adding some for the protective puts for that part of the skew, and either subtracting very little or adding more for the call options, which is going to keep VIX looking higher relative to at monies across the board. And again, what it does mean is if you're a writer, a lot of you write covered calls, I would expect to see that this becomes a somewhat better environment for you to do that. There's a lot of moving parts, but this is the way I'm thinking right now. As of now, market's kind of meandering. If it's consolidating at levels around here, that's not the worst thing, because it kind of needed it after the run we had. We'll see if that actually flips a bit lower, but buy the dip remains a very strong theme. So as of now, I'm looking at some meandering. I have a feeling this afternoon might be quiet, because yesterday was quiet until the catalyst of Chairman Powell. I think a lot of traders were watching CNN and the like rather than CNBC and Bloomberg and the like. I think we're going to start to. I think today you'll see more focus on what's going on in Washington than what's going on in the market. So you may see some quiet as the day proceeds. Anyway, good talking to y'all. Take care. Bye-bye.